if you want to go off in different directions, you're certainly welcome to. We can chat about anything that you guys think is relevant. Let's start with MIGA. Jason brought up a MIGA out there. Let's start with just currently my favorite MIGA. It's with Pacific Guardian Life. It's an AmeriLife exclusive. If you don't have access to it, we do, but you'll get a better deal if you just go to AmeriLife Direct. I will give you a piece of advice. I don't know if we have any AmeriLife guys in here or not, but I don't think they would disagree with this if I said it with them on the line. They don't like to release. So that fact simply for me would give you guys a warning. If you wanted to get a deal with them, make sure you get a signed upfront document agreeing to release you with a 30 or 60-day notice, and probably even make it pretty bulletproof. Congratulations to them. They were able to get this A-rated carrier to build a MIGA that the product itself is spectacular in its design, meaning no MVA, 10% withdrawals every year, including what they call a lifestyle additional 10% withdrawal in any one given year. So basically 1 year you can take 20% out, every year, other year you can take 10. The really big important part of that, in my opinion, and this depends on how much you like to really dig deep into product with your advisors, is the no MVA. Rates are going up. Everyone knows it. It's in the Wall Street Journal every day. Inflation's here to stay. Rates are going to start to go up, and we've all experienced the MVA roll in the positive direction. That's going to get ugly in the negative direction, right? If rates double, we can only imagine how bad surrender charges you're going to get for clients that want to get out. So imagine a scenario where you put a client into, I don't know, just pick a product, say a 315 for 5-year guaranteed rate with Sentinel Atlantic Coast Life with an MVA. 2 years from now, rates are, let's just hypothetically say 6%. And that client wants out of that 315 to get into a 6. I don't think they're going to be able to, guys. The surrender charge is going to be crazy high. Well, with Pat Guardian Life, we have a set known surrender schedule. If, let's say the surrender in that second, third year, don't quote me on this, but let's just say it's 7%. I might want to pay a 7% surrender charge to get double my interest rate for the next 3 to 4 years or 5 years. A consumer that's in a product with an MVA, they won't be able to do it. So that feature on that product is outstanding for a consumer. And the rate's good at 3% for the 5 years. They're in Hawaii, so that's a little bit of a struggle. The time zone differences can be challenging for customer service. The other one is they're not a huge annuity carrier, right? They're not in our space. They don't really know what they're doing. I put quotes around that. So you're gonna have to expect some service problems with them. If you don't have access to it or you don't want to go through real life, we got the deal. But you're gonna have to give us a cut, whatever our deal is together. If you guys want to run that through us, we'd love it, of course. But like I do with all my friends, if you're looking for the best you can get, I would just call AmeriLife. I've got friends over there. If you are looking for a referral, Dan Gunther is one of the AmeriLife shops. I can't remember what his company's called, but he's a great guy, and he would give you that upfront release. I think he makes a quarter point, so I think there's a buck in it. He gives I think all AmeriLife shops give everyone 75, so they can keep a little bit on the deal. They are planning, I think, in the near future to build some FIAs. We'll see how competitive those are when the time comes. And then to get into Jason's specific question, he was asking about a 3.5 guaranteed 5-year MIGA. We saw that a couple weeks ago, offered from Gillico. I think it's the same product he's referring to. And there's another one out there offered from Great American on the same type of platform, meaning that it doesn't pay any commission. It's a 0% agent level commission. They do have an override built into the products with both of them. Not sure what the Great American one is. I think the Gillico one is 1% to ECA. But the bottom line is that they're designed for fee-only advisors. They're not designed for reps that can take a commission. So the advisor can charge the client up to a maximum of 1.5% annual fee. This is specifically for Gillico because I called and talked to him about getting access to it. So they can charge whatever they want up to 1.5. They got to disclose it on the application, how much they're going to charge their consumer. And if it's qualified money, Gillico will take it out of the client's account on an annual basis and mail it to the producer via a commission. It will not create a 1099 for the consumer because, of course, the agent gets it as a commission. The agent has to pay tax on the money there. Gillico is offering it to us, but they're putting kind of some weird stipulations. They want us to sell more of their products in general to give us this access to this limited distribution kind of product. And I'm not sure we can sell it. We certainly work with a lot of RIAs, but almost all of our RIAs in our space at ECA are duly registered RIAs where they can receive commission and charge a fee. So I think most of our reps would rather sell, say, 3% for 5 years and get a commission versus 3.5% for 5 years and take a 50 basis point fee, which ultimately ends up being the same 3% anyway. If it was an A-rated company, I maybe would have a different feeling for it, which then leads to Great American. And I believe theirs is actually at 3% with no commission. So you could look at doing that as well. So, your guys' individual firms or advice to ECA, if you're running, most of your business or all of your business through ECA, if that's something you think you can sell, let us know. Like I said, I'm pretty sure we can get access to the Gilco one. We do have access to the Great American one. If you have questions, talk to your internal wholesaler. We'll probably line you up with someone over at Great American that can share better details on that. Outside of that, MIGA rates are actually staying pretty level. I read an article in one of the trade pubs a couple of weeks ago that talked about don't expect bond yields, treasury yields and stuff to go up as fast as inflation does. So they're anticipating there's going to be a lag behind it. So if you've got advisors you're working with that have clients that are considering MIGA or fixed annuities in general, but maybe wanting to wait till interest rates go up, it might take a while is the point. So I don't know. On that one, I certainly wouldn't tell a client they were wrong if they wanted to wait and see. I wouldn't tell them their decision's wrong, but of course I would try to encourage to get a sale to happen. I do think we're going to see interest rates go up, but it might take a year in our space. So we'll see. And then how fast the carriers go up with that is always a big question mark as well. We've seen a little bit of an increase on rates, but not nothing huge. So MIGA business still stays strong for us at ECA. We do a lot of it kind of all the time. About 25% of our business is MIGA. And I think the Pat Guardian one is our biggest seller today. We always sell a ton of SILAC that just kind of flies off the shelf in their 2- and 5-year products. I like the 2-year today. Why not lock in for a real short period of time? And then when the money comes free, hopefully rates are higher. We can go back into that one. Couple other product things just to kind of go over. One I'm honestly very excited about, which I haven't been, frankly, in a long time, is this new product that's limited distribution. I say limited distribution, but it's really not, because it's Brokers International and some other commission club, Partners Advantage. So both of them have 20, 30 marketing companies kind of underneath them that aggregate through them. So lots of companies have it, but a couple of the big ones that we compete against regularly don't, at least not yet. I'm sure one of us will give it to these guys, but as of right now, Advisors Excel and AmeriLife don't have it, and Simplicity doesn't have it. But they all got lots of friends. If they called me, I'd give them a deal, right? So they probably already called someone like me and got a deal, so they likely would have access as well. But we may have a little advantage on recruiting because our deal might be better than those guys end up getting. So their new product, it's developed through Legacy Marketing Group, and Americo is the insurance company, A-rated company. Legacy is great because they know what they're doing service-wise. They'll be able to be efficient when it comes to doing the things that we need done. And the product has some really amazing, unique features to it that we've either not seen before, or we've certainly not seen from an A-rated company. A couple of them, first, it checks the right boxes with commissions and overrides. Again, talk to your marketer on what those deals are. Really nice bonus built into it for us as well that we can hit if we do some production. Both a 6-year and a 10-year product. The minimum guarantee is the first really good feature, in my opinion, 1% on 100. That's a great thing to not have to just explain to a consumer the 1.5 on 87.5% of the premium crap. So the 1 on 100, I think, is a really great deal as a worst case scenario. So at the end of 6 or 10 years, no matter what the index credits, you're going to get 1 on 100 compounded annually for either the 6 or 10 years. That gets missed, I think, a lot in our business. I think that's a really strong feature for consumers to understand, because the 1%, especially on the 6-year, that's probably competitive with what CD rates are paying them. And that's the worst case scenario on this thing. So that's pretty strong. Where the real power comes in this thing is they were able to do some guaranteed par rates, no moving parts for the life of the surrender period. Not the contract, because if they stay beyond the 6 or 10 years, then they can change stuff around. But only on the vol control indices. They've got 2 of them. One's the SG Global One's Morgan Stanley. And Diane, I'm going to ask you, see if you know, or Kyle, which one has the 10% vol control instead of the 5? I forgot. One of the two is a 10% vol control and the other one's a 5% vol control. I'm a big fan of the 10. Do you guys have that? Anyone have that in their notes?
I do.
Pat, was that a yes?
It is Morgan Stanley.
Morgan Stanley, okay. Which is even better because I actually kind of like the name Morgan Stanley. I'm not sure that that's, Pat, did you have some more to add?
Yeah, she's right. Yeah, Morgan Stanley, 10% and 5% the SG.
Yeah, so a 10% vol control feature basically just means you're going to have more money invested in equities for a longer period of time than you would on a 5% vol control. If you look at all the other carriers that do these vol control indexes, when they come up with the higher percentages of vol control, they typically have much lower par rates. And this one, it's just not the case. The par rates are very, very close to what they are on the 5% vol control. So I believe that it gives you a better opportunity for better accumulation by having that higher vol control feature on there. And I think that's something you can talk to your advisors about. Again, it gets a little bit into the weeds on the product, right? It's a little bit of how the watch is made, not what time it is. But I think it's important for the advisors to at least have those conversations with their wholesalers because they're looking for our advice, right? They're not just out there having us tell us which products to sell. They're looking for our advice on why we think they should sell what products. So to dive into it, it's got a no fee version and a optional pay a fee to get higher par rates version, which I also love in our current business. And it basically doubles the par rates on these things to pay the 1.5 fee. So annual point to point or a 2-year reset point to point crediting strategies. The one I like again is the Morgan Stanley. If you go at the annual reset, 53 par rate. If you add the 1.5 fee, it goes to 106 par rate. If you go at the 2-year reset, which I actually like better, even though I know we sell less of it, starts with an 82 par rate with no fee and doubles to a 164 par rate with the 1.5 fee. And this is the 10-year product. And again, those are guaranteed, no moving parts. They can't raise the fee. They can't cut the par rates. There's nothing they can do to try and hurt us on renewals. So as a wholesaler, what I'm thinking is have a conversation with some of my producers that I know sold some companies that had bad renewal rates and just start with that open-ended question. You know, hey, Jason, are you tired of some of your carriers hurting your clients on renewal rates? Right? Whoever speaks first loses. Jason says, yeah, I'm tired of that. You lose, Jason, because now I just got an opportunity to pitch you on a product that's got no moving parts. And that's a big win. Oh, and by the way, it's an A-rated carrier and it's got a 1 in 100 minimum guaranteed contract value. So I think a great feature or great product for us wholesalers. I don't know if reps are going to love it, if it's going to sell a ton, but I know that as a wholesaler, it gives me some ammunition to make some phone calls to some producers and tell a story. To look at the 6-year product, not significantly less participation rates, which I like as well. Again, on the annual reset, no fee. Morgan Stanley 50% par, pay the 1.5 fee, goes to 103. 2-year 78 par, no fee, 160 par with the 1.5 fee. You can change your mind on that every reset. So if you do the 2-year, every 2 years, you can go with or without fee. Little sales strategy around that. If your advisor thinks the market's going to crash in the next couple of years, probably don't want to pay a fee. Why would you pay a fee for a 0, right? If you think it's going to get a 0 or negative. But then maybe after the crash happens, then you jump in and pay the fee to participate almost double in that new upside. And again, it does reset at that lower number. So if we get a market crash in the first couple of years, we reset at that lower number and have more upside opportunity within the product. Checks all the other boxes, 10% withdrawals, good death benefit. Americo is a good company to work with. I wouldn't put them in the great category. They're not going to be an American Equity or an Equitrust service-wise, but they're going to be pretty good. They have real people there that can help get stuff done. If you guys run any problems, we have friends over there. ECA's got a really long-term relationship with them on their direct products, as well as the stuff that they've done through Legacy now.
Hey, Joe.
Yeah.
Hey, sorry to bother you. Does anybody know the Morgan Stanley Enhanced Allocation and the SG Global, are they indexes available in other FIAs or are they just exclusive to Legacy?
I do not know that answer, but I can certainly get it from my Legacy guy.
And can you also
I
ask,
wrote down in my notes that the Morgan Stanley one is the only product that one's available in. I think the SG is available in others though.
It is.
It is.
Yeah, the SG is, and I think you're right. I think you're right, Pat.
And that would make sense because if you look at the back testing on it, it's not very good. Meaning there's not a lot of data. So it likely is a brand new index. So we'll confirm that for you guys too, but it sounds like you've got that locked in. I didn't mention it's got the other stuff too. It's got the S&P 500 par rate. You can go with or without fee. It's also got it with a cap, with and without fee. And then a S&P 500 Mark 5% vol control par rate with and without fee. So if you are looking for it, we have all the rate sheets, the commission grids, we have the kind of the stuff. It rolled out yesterday was the first day that it launched. So it's available out there. It's available in most of the states. I think there's like 5 states that it's not in right now. So you'll see every marketing company's got access to it. It's probably going to be doing some kind of an email blast saying something about, tired of bad renewal rates, how about some guarantees. The only other guarantee index I know of out there, I think, is Sentinel and Atlantic Coast Life. I think they've got it. Again, B+ companies versus A-rated companies. It's a 9-day difference there. And then I think theirs is not available on the annual reset. I think this is the only one that guarantees the par rate for the life of the contract with an annual reset feature. Yeah, I wish it was on the S&P 500, but we all understand why the S&P 500 volatility is so much higher than what you get on these vol control indexes that they just can't afford to do it. So the stuff's available. Like I said, talk to your marketer here if you work with someone and they can get you information. There is a microsite available with a bunch of kind of materials on there, I think including illustration software. But if you want to, get out there and get going on this, it can be a winner. The 6-year can be really a winner, in my opinion, in the BD space. So if any of you have relationships within BDs and you want to try and get in there, I would move fast because we're not the only ones that are going to be thinking this way, right? Everyone's going to be trying to get into the BDs. Good luck.
Joe, illustration software is not out there.
Not yet.
No, they won't. From what I understand, they won't have it on their microsite unless we hear something different. And this one doesn't have a market value adjustment either.
Yeah, that was the other key feature. Thanks for inviting me on that, Diane. So there's 6-year product, no MVA, 1 in 100. I mean, it's almost a MIGA alternative, right? And it's got really good upside, in my opinion, on what it can do as far as returns. So I thought just great story. I thought great design by Niju over at Legacy to put this product together. They did warn us that the others that don't have access to this, they're going to come out with a proprietary product that we will likely not get access to unless we get it through a friend. And it's going to be an income rider focused product, whereas we got the accumulation focused product. So Legacy's current strategy is to design products for separate groups, apparently, or at least they're going to try it on this one for their first attempt. So we'll see what that one looks like. Again, I'm sure we'll get access to it through a friend somehow, but we won't have, quote, direct access. Interesting couple notes on this product. If you have a rep that's already licensed with Legacy and already licensed with Americo with Legacy, but with a different FMO, they can choose to use us for this product unless it's one of the other FMOs that already has access. So if you've got a rep that's with Advisors Excel, as an example, with Legacy, with Americo, because Advisors Excel doesn't have access to this, your rep could get licensed through us, through you, for just this one product. So that's kind of a neat feature. So I think it gives us a lot more recruiting opportunities than what the normal Legacy kind of products are. It is a separate kind of licensing addendum if you have a rep that's not licensed with Legacy and they want access to what they're calling, I think, the shelf products or the Legacy products, versus this one, it's an additional addendum form. Again, Legacy knows what they're doing when it comes to this stuff, so it won't be a big challenge. Our licensing staff is up to speed on it, and if you're running this through us, we can certainly help you out and kind of all those different things. The other one we want to bring up, and Diane actually brought this to my attention, so thanks, Diane. About a week ago, Equitrust came out with a couple new products, Market Max and Market Force. These are accumulation design products. One's with a premium bonus, one's without a premium bonus. Both of them have a fee to buy up higher par rates, and they have some of the best back testing illustrative rates out there when you use the fee. Where I think it's a fit is there's not a lot of products out there, with a true premium bonus up front that has actual accumulation potential. Most time when you get a premium bonus slapped on there, you get like a 2% cap or something stupid like that. So there's one of the strategies is the Barclays Focus 50, and the S&P Mark V with the fee and the 8% premium bonus, they're showing really good returns, over 8% for best case and like 5.5 range for worst case scenario as far as back tested returns. And that's really high for a premium bonus product in our business today. So if you haven't looked at those with Equitrust, both of them are, by the way, all these products, these 10-year products, now it seems like everyone's coming in at 7% street level comp, which both of these have. So that's a good commission for our producers to deal with. And a unique can probably pick up some unique sales opportunities with covering a little bit of surrender charges that are being lost by replacing or whatever that you need to do on that. So if you're looking for more details, we got all the rate sheets, the illustrations and stuff here. Talk to your marketing, they can certainly help you out with any of that stuff. We love Equitrust. We've been working with them forever. They're our second favorite service company behind American Equity. They do a great job. There's real people there that you can call and talk to about issues, and those people can actually make decisions to help get stuff pushed across the finish line for us to get business done. Last product one, and then I'll get off the product stuff unless you guys have some other ones you want to ask me about or others on the call about, is just wanted to make sure everyone saw Ocean View added the Credit Suisse vol control strategy to their index annuity. Their 10-year product has really good participation rates on the S&P 500. It's, I think, the highest, at least it's one of the highest. I think they got 40% par on the annual and 60% par on the 2-year reset. Believe that's either the highest or tied for the highest without a fee in the business today. And their new Credit Suisse product has, I will call it, pretty good par rates. I don't think they're the best. I don't think there's anything all that exciting about it, but for those producers that like to have at least 2 index options for the client to change their mind and jump in and out of on an annual basis, on annual reviews, it's got that second option on there now. Again, another 7% commission on the 10-year product. So Ocean View does want to get into the index space pretty bad. They're kind of tired of being MYGA only. So they're putting their best foot forward, I think, in designing product, at least right now. And I think we've sent you, but we'll send you all the rate sheets on the follow-up email to the call here today. Last thing I wanted to mention is just a resource for you guys. If you go to our website, we added a DOL Carrier Resource Center. So the new fiduciary rule went into effect, and reps are obligated to be acting as fiduciaries for qualified monies. Every carrier seems to have a little different stance or direction on what to do with this thing. Some are requiring the form, they want to see a copy. Most are just requiring the form, they don't want to see a copy. Some will provide a form, some won't. We have a generic, I believe it's on the website, that if your reps want to use it. If you're talking to reps and they start asking questions, the really important part is they are using the 8424 disclosure form. And most carriers, again, don't want a copy. We certainly don't want a copy at ECA. I think best practices for all of us, unless you are supervising your producers, is to not request a copy of these things. I've had a lot of questions like, well, if no one wants to see a copy of this thing, why do I have to fill it out? Well, if you ever have a complaint file with the state insurance department, the first thing that they're going to ask about is a copy of that form, make sure you did it. If you didn't, you'll get in trouble. And I don't think you want to get in trouble with the Department of Labor. So Mr. Producer, please at minimum, fill out the form. At maximum, do some research on your own. If you're a huge producing firm and you're making, tons and tons of money, you got staff and the whole thing, you may even want to consult with an attorney on your own and get an opinion from that attorney based on the kind of business you run, right? If you're an RIA guy, you're a BD guy, or insurance only guy, there may be different opinions on what you should or shouldn't do. May want to build your own form, but it's pretty simple to follow, right? You got to act in client's best interest first. You got to act like a fiduciary. You got to disclose any conflicts of interest. If one of the conflicts is that you're a Mass Mutual career captive agent and the only thing you can sell is Mass Mutual, you got to disclose that. If you're an independent rep and you sell 70 companies like we do at ECA, you guys got to disclose, I think it says 2 or more. The hard one is the disclosure of commissions. I don't think most producers are struggling with that. I've had some producers build their own form and they, instead of saying what their upfront commission is, they just disclose what their annual commission is. So if it's a 7% commission on a 10-year product, they say they make 70 basis points per year. Whether or not that would fly in a court or in front of the DOL, I can't comment on that. I would say that it would probably pose some questions to the advisor, but nonetheless, that's what some are doing. Again, I'm not giving any advice on this. I'm just telling reps to make sure they do the form. Disclosing upfront, I don't think is a big problem on the annuity side. Where I think it is a problem is if you have reps that are playing in the qualified life insurance space. We've seen a lot of cases the last couple of years of qualified monies being transitioned into life insurance, and we've seen some big cases. In fact, we probably average 2 a month that are, call it, north of $50,000 to $100,000 in target premium. And when that producer has to disclose that he made $110,000 commission on the sale here, that might make a consumer choke and maybe make them not want to buy that life insurance sale. I don't know. I don't think I would feel very confident sliding a disclosure form across the table and showing my consumer that on their $1 million rollover that they're doing into life because they want to get their taxes paid for today and not have to worry about them going up in the future, I'm going to make $100,000 commission. I think I would probably have a hard time not stuttering if the client started asking me questions. So I'm a little bit nervous on that aspect. I'm even more nervous that reps on the life insurance side are not going to do it because I don't know that they know they have to, but they do, right? You give investment advice on qualified monies, you got to do a form, period. If you're having reps do that stuff, I would give them the advice to make sure that they're filling out that form. And I would guess that on the qualified life space, we're going to see carriers pushing harder and harder to a spread comp instead of an upfront comp, right? Instead of showing 110% upfront, we're getting 8% a year forever, 14% a year forever, something like that. Even that's tough. I think it's going to be tough for some of those reps to disclose those commissions. So did have one question specific pop up of that. What if we roll it into a SPIA and then have the SPIA fund the life insurance? You still got to do it. Again, that's my opinion. If you had an attorney say something different, I'd be interested to hear how they can justify that. But you're giving advice on the SPIA and you're also giving advice on the life insurance. And those are still both qualified funds. So I would say you still have to disclose both of them, but is what it is. So be warned. The Resource Center I think is awesome because we go basically and get every carrier's communication to the field on what their thinking is on it, what their requirements are on it. If you have a question that pops up per carrier specific, use that resource to your advantage all you want. Other than a sales conversation that I wanted to have with you guys, that was it as far as products. So I want to open it up quickly first to see if you guys had anything product wise that you think we should discuss on this wholesaler call.
Hey, Joe.
Go ahead.
Sorry about that. Hey, Joe, this is Jason, another Jason. If what I can do, we did some big research on our PTE 8424 form. We came up with our own. We checked with several of the compliance at some of the biggest insurance companies out there and gave it to them to look at. And although they wouldn't put it in writing that it was great, they, for the most part, all gave it a thumbs up. So after some major tweaking, we got it down to 1 page, and then our advisors have been using it this month. And so far, so good, especially the way the comp is explained. We try to make it as producer friendly as possible while still sticking to the guidelines. So you do so much for everybody else, man. I'll get that over to you. And then if you like it, feel free to use it, disseminate it or whatever. Take a look at it at least. So
awesome. Thanks, Jason. I appreciate that.
Sweet.
Jason Brown, you're up.
Oh yeah, I just wanted to say, Joe, hats off to you and ECA Marketing for building out that resource page. I think that is awesome. So hats off to you guys. I appreciate it. I'm sure we all do. It's a good resource. Really is a good resource with everything going on.
Anything you want to piggyback off there, you're always welcome to take any of that stuff and white label it on your own website. So yeah, we thought that was a good addition. There's some other resources I think on there with the DLL stuff related, but it's just
the other thing is I was just going to mention everybody, if depending who's working with Legacy or not, but on their website right now, I find it interesting, the classic mark, future mark, and Liberty marks on there under Americo. But this new one isn't yet. So it's probably because of BI and Partners Advantages. Is that your thinking as well?
Yeah, that's exactly the reason. So they actually don't want to be the marketing company for that.
Got it.
What they're telling us is all their other products, when you have questions, they want you to call Legacy. For this one, they actually want you to call us.
Okay.
So it's going to be on a separate site. I don't think you'll ever see it on the standard Legacy site.
Makes sense. Thank you.
Yep. Anything else product wise? All right, I just want to get in a quick little discussion because I've had a lot of success with this kind of sales conversation with producers over my career. And it's really what I call the difference between perceived value and actual value on products. And I'm not leaning actually either direction on this because I believe that fixed annuities are fixed annuities. They're going to give you whatever they're going to give you on return. There's typically not a carrier out there that has some secret magic that's going to give your client, let's even say just a 1% better average return over the life of the contract. It may do a little bit better, maybe do a little bit worse, but for the most part, these products are the products, right? They all have the same amount of pie to chop up in different ways. Higher rated carriers are higher rated because they're more profitable, right? Bottom line, if you want to have an A+ rating, you got to show big profits to AM Best. So AM Best gives you a good financial strength rating. That doesn't mean that they're giving you a rating based on how good your products are for the consumers. But how much difference does that really mean in yield to a consumer? My guess is the difference between a B+ rated carrier and an A+ rated carrier is probably 50 basis points a year that the lower rated carrier invests into the product to make the product better in one way or another, right? Better rates, better income, or better commissions, or better overrides. Whatever that deal is, I don't think it's that significant that it's going to be night and day different for your consumer. So a lot of us wholesalers, I think, spend a lot of our energies trying to pick the best product for our customer. And I think that's for a good reason because, the sales process is really, it was explained to me one time, is that in order to make a sale happen, the salesperson has to transfer their energy and their excitement about the product to their consumer to get their consumer to want to say yes. So for us wholesalers, it's great that we do that research and that diligence to find what product we think is best, because it gives us ammunition and power and confidence on what we're pitching. But I think we all know one really big thing: the products are going to be all about the same, right? We can pick on certain carriers, and I certainly have my favorites. I don't like to say their names on here, but I think most of you know. We've got certain carriers that do some fancy gizmos with their products to maybe make them look better, and that's what I call perceived value. Now, I don't mean that in a negative way. I actually mean that in a very positive way. What I mean is there's a couple different things that makes a sale happen. One, you convince a consumer that you're a really smart advisor and you're really on their best interest, and they're going to take your advice. And in that scenario, I think that you do want to pick what you believe, based on your diligence that you've done, is the best product for the consumer. And then you've got a kind of a second consumer that's skeptical, that they're whatever. They need a bonus. They need a perceived value that's going to make it better, right? So it's funny, throughout the years of products that we've seen, there was one product, I don't remember who it was, but they gave a client an option with or without a premium bonus of 10%. The one with the premium bonus charged a 1% annual fee. But there was a perceived value that the client saw there, that they bought the bonus product because they liked the 10% added to their account value day one, guaranteed. That's a perceived value. It's not better for the consumer. It was actually worse for the consumer if you ran it out on a back tested rate. But does that mean it's a worse sale for our advisors? No, because they need to put food on the table. They got to get a sale to happen. So these gimmicky things aren't necessarily bad, even though I think us wholesalers at times do so much due diligence and number crunching on them that we get frustrated at times with them over what? Hypothetical, it's going to earn our end consumer 25 basis points less annual return. But the producer was able to sell one and they weren't able to sell the other one. So the one that we wanted to sell, our due diligence said was going to give a better return over the life of the contract. The producer goes to sell that and they can't get the sale to happen for whatever reason. And that's because they needed that perceived value to get the consumer to say yes. So what I wanted to just talk about openly with all of you on that is that idea of picking a product that's really sellable versus the best product, right? And I'll give you an example. I remember back in the day when daily averaging came around, and I remember we had 60% par in the annual point-to-point S&P, no cap, no fee, and 100% par with a daily averaging annual reset, no cap, no fee. And I banged the drum, you guys, like you wouldn't believe, trying to get my reps to sell 60% par all day and all night. Guys, would you rather have 60% of all the return or 100% of half the return? That was my line, right? And I was trying to get these guys not to sell this daily averaging because I thought it was a turd and I just didn't think people should sell it. 60% or 65%, whatever it was at the time, on the annual point-to-point par just back tested better. And in my research and my investigation, it was going to do better for the consumer. Why did I do that? Why not just give them the option? What's more sellable, 100% par or 60% par? Which one's going to do better in the long run? Well, the truth is the 60% par did better in the long run, but by how much? Was it really enough to have an advisor get 6 out of 10 sales versus 8 out of 10 sales? What's better for us as wholesalers to make a recommendation to our advisor? I think that we have that conversation with them, and we say to our advisor, which one of these is more sellable? This one's going to maybe give you a little better return in the long run, but when you're sitting across the table and you got your elbows on the table, stick it in that jelly, right? When you're sitting across the table with Mabel and Stu, which product is Mabel and Stu going to be more likely to buy? 100% par or 60% par? That's all they hear. Mabel and Stu don't know what daily averaging versus annual point-to-point mean. They just want to know what's sellable. And are we harming our clients by selling the daily averaging, knowing that it likely will end up returning about the same factors, right? Because just because we had 60% par that first year on the annual point-to-point, what's the likelihood that they're going to be able to sustain a 60% par on the most volatile index we have, which is S&P with par rate, no cap, no fee. So we've all seen those renewal rates go up and down both actually on renewal because they are extremely volatile. The monthly averagings or the daily averagings, we didn't see as much of a shift. So where that goes into today is income riders with huge upfront bonuses that are performance-based and performance-driven. You know, guys, they sell a ton of those things, a ton of them, because they've got really big upfront perceived value. And I guess what I'm saying is I'm making a recommendation, take it or leave it. I'm not claiming to be the best wholesaler out there and never have claimed to do that, but I've got the soapbox right now that I'm standing on. You know, tell them what you want to tell them, but then sell them what they need, right? Let's get some sales to happen. Let's get some sales across the plate. So if I'm making a recommendation, it's going to be as a wholesaler, pick your favorite product and then pick your favorite perceived value product, which is going to be sellable. And that doesn't mean pick the biggest turd perceived value product out there because it's got the best gimmicky, you know, smoke and mirrors thing. Pick the one that's your favorite. And, you know, one of my favorites, and you guys might disagree, and I hope some of you do, I don't like 160% participation rate products. It's too confusing for a consumer. How can you give me 160% of what this index does? My stockbroker only gives me 100% of what it does and then charges me a 2% fee for that. How can you give me 160%? I'm questioning you right now as a consumer. So just me personally, I like to pick a product with like a 100% par sounds great. 90% par is probably a more realistic buy for a consumer, but then it's got to have something shiny on it to get that consumer to say yes. And that could be a big premium bonus. That could be a income rider that's got a perceived value to it. I'm not saying misrepresent the product. And I know people have done that with these income riders. We'll guarantee you 7% for 10 years and then you turn the income on. Not that crap. I'm saying give them the shiny little object on the perceived value and then get them into whatever your favorite is and make a presentation to your producers on why you think that product is something that they should have in their suitcase. And I think you'll find some good success with that. On the flip side of the coin, I think you should pick your favorite product always on top of that. And again, these advisors, they're leaning on us for consulting, right? They're not just asking us to tell them what's going on in the business. They want your advice. They want you to tell them what they need. They really do. They're lonely out there. And that's the biggest flaw in our industry and in our independent space is we don't have a lot of sales training and sales coaching anymore as advisors that are out there, you know, running door to door trying to make a sale happen. So they're relying on us to give them some of those advice things that they used to get from their sales managers. And that's really our role, as well as, which I've laughed my entire career about, because most of my career, I felt like the pond scum of the industry selling fixed index annuities and fixed annuities. Like all these other investment advisors are so much more intelligent than us because they sell these big fancy products. Then the flip side of the coin, like there's days where I'm an attorney, there's days where I'm a compliance officer, there's days where I'm a CPA, there's the days where I'm an investment advisor that's giving them investment advice on the fancy REIT that they heard about. There's days that, you know, we really do wear a lot of hats in our role. And I think that's something that we should be proud of. And I think that we should actually think of ourselves in a consulting role rather than just a fixed annuity wholesaler role, and give advice. Really big important thing I think for all of us wholesalers is that we should be giving advice, right, to our advisors because they need it. Because I will tell you that even though we're just fixed annuity wholesalers, we know a hell of a lot more about what we do than they do, right? We know our products are really, really well compared to what they do, and they need our advice because they need a place to put their clients' scared money, their fixed money, their safety money. So thoughts, if anything, anyone else wants to share anything? Otherwise, we can get on with our Wednesday and you can quit listening to me rant on.
So Joe, I think you're so on point with that, just the whole conversation of this topic. And to take it a step further, what I would add to it beyond what you said is from the advisory standpoint, when I'm talking to someone, this just happened literally a couple days ago. So how about the fact that the agent with the customer is just trying to sell an FIA? Why not step back and make sure the FIA is, appropriate versus a MIGA? So many agents are out trying to sell FIAs and they're stepping over so many dollars to try to get there. Instead, to take it a step further, give the customer what they want. We all know that's what should happen. But in reality, they're going out and they're trying to sell the FIA and whatever their favorite is, whatever they have in their bag, so to speak. But just to take it a step further, what is wrong with giving someone what they want? People only buy things for two reasons, because they want it or they need it. So our job when we're working with the agents, at least from my perspective, is to make sure they have what those products are so that when they go out, they're confident that they have that. And like you said, let's put it in a container or buckets. What's your favorite go-to accumulation FIA? What's your favorite bonus FIA? What's your favorite MIGAs? What's your favorite income rider with a fee? What's your favorite income rider without a fee? Just to keep it kind of sort of simple, but just taking it back to giving them what they want, giving and making sure agents know, like your MIGA sheets that you guys send out, that Heather sends out. I love that thing. There's so much power in that, because if you go look, as we all know, go look at bond rates, go look at treasuries tips, go look at anything you want, go look at CD rates, and look what we have as agents right now, or as wholesalers, to provide to, as from the manufacturer, to the wholesaler, to the agent, to the client. 3% for 5 years or whatever rate you're using, and we go look at what the bank's paying. I mean, come on. So I'm a huge, hear my heart, I'm a huge FIA or index, advocate all day long. But if the client doesn't want that, and that's not what they're wanting, then it doesn't matter. We need to give them what they want and what they understand and what they're comfortable with. It doesn't mean we don't try. If we have conviction and passion that we know or we believe over time, that's going to perform better. But back to what you're saying about perceived value. Perception's reality in the eye of the consumer. Number two, price is only an issue in the absence of value. So, back to fees and so on and so forth. Nothing wrong with selling a product with a fee. In fact, go look at the top 10, 20, 30, 40, 50. When you go run comparisons, when you go run an income illustration comparison, guess what you're going to see in the top? Everything at the top tier is going to have a fee. We probably here all know that, and there's nothing wrong with selling products without a fee. But if you're really going for the best lifetime income, there's going to be a fee with that the majority of the time. So anyway, but I think you're right on point with this. The topic's great. So thanks.
Yeah. Speaking of income riders, I just want to throw out just thanks for the reminder, Jason. We have a really good deal with Minnesota Life. If you guys are seeing Minnesota Life show up on your income rider comparison spreadsheet, give your wholesaler internally here a call, because we've got I think there's 2 marketing companies in the industry that have a sweetheart deal with Minnesota Life, and we happen to be one of them. It's just coincidental that we're in Minnesota. It's also Securian, if you guys didn't know that, but I ran some quotes last week for a guy with a 10-year deferral, and I think they showed up second place on both with and without a joint income payout. So if you run across Minnesota Life, give us a call first, because we might be able to get you a little bit of a raise on what you're earning on versus where you're at now. Anything else, guys? Thanks for sharing, Jason. Guys, it was great to see your faces. Thanks of you brave souls that showed your faces today. It's been a long time since we've done this, so I don't like doing this to waste time, and I just didn't feel like we had a lot of content to deliver the last couple months, and with year-end stuff happening, again, we'll do these as often as you guys want to. At some point, I still have a dream that it's not going to be me hosting, that one of you guys would host one of these. I think everyone on here is more than capable of doing it, but it takes a little bit of research and jot down some notes on what you want to talk about and why you want to talk about it. And just to give additional kudos to Heather, she puts together all the notes for us leading up to these and coming away from these. She also puts all my notes together. She pays attention to what I'm talking about on my daily basis and jots down ideas for me to come up with to talk about on these calls. So thank you to Heather for that. And then, side note, guys, go to our website. There's tools and resources. Me and Latuga were talking yesterday about Annuity Rate Watch and CanX and all those different softwares that are out there. I guess we got a little bit more time, and I'll dive into just that quick. If you want to jump off, I'm going to talk about third-party softwares that are out there for a minute. I get very frustrated with them. I'm just going to throw it out there immediately. Indexalizer, I think is what it's called. Kent Jackaway's software. That's currently the only one that we're paying for. Some great stuff on there. There's other ones out there. Annuities Genius. There's Retirement Analyzer, Retire Up. There's 20 of them, right? Here's what happens with my position every time. One of my 20 marketers will come to me because their rep told them about this great software that the rep couldn't make a sale if they didn't have this software. So we got to have it. We got to give it to every one of our marketers and every one of our reps for free because we want to provide value to our advisors. So I'll go out there, I'll spend $5,000 to try this thing for 3 months. And then I'll look 3 months later without talking much about it. And I'll see that one rep used it. One marketer used it regularly. One marketer used it twice, and no one else even logged into the system once. So that's been my history with just about every software. I will tell you from my perspective, software does not sell ever. Illustrations, yeah, if you need a quote, you need a quote, right? But a fancy software that's going to tell a consumer a story on a software, it doesn't help make a sale get pushed across the finish line. But what that did lead into, and talking with Jason about it yesterday, before, is there are tools that are necessary. Annuity Rate Watch is really handy. It's got an income rider comparison software. It's got all the rate sheets. It's got most of the time the riders are on there. The liquidity provisions, the death benefit provisions, the street level commissions are on there. State approval, state variances are all on there. That kind of stuff is absolutely necessary, especially for us wholesalers. CanX is the SPIA quoting software. ECA is unique in the fact that we push SPIAs. We don't sell a ton of them right now because they suck, because rates are so bad. But we can quote out weird companies like New York Life and Mass Mutual and like all those weird companies. So if you need that one, it's on there. Other softwares that are important, I think, in the FMO space is Firelight for electronic submit. iGo or iPipeline for life insurance, electronic submit. And then, of course, SureLC, which I think everyone has either their own or one through us for licensing and that kind of thing. So, those kind of softwares are absolutely necessary. If you run across the software and you want to throw it by me, shoot me a text or shoot me an email. Ask me my experience with them, and I'd be happy to provide that. I will tell you, just from my standpoint, most of the time, it's not going to be a positive response. I've yet to see one that helps producers sell product. So again, let me know if you run across one, and I can. At best case scenario, I can tell you how the experience went that was not favorable and help you not waste your money doing the same thing. Indexalizer, we're paying for it. We like it. My marketers will use it occasionally, I will say. I think most for themselves because they like to see what some of the back-tested non-carrier biased opinions are on the vol controls. And they really do a great job comparing so many different vol control indices. And what's unique about it, I think, that if producers wanted to use, which again, for the most part, they don't, but if they wanted to, they could go in there and they could plug in this, pick on one, the 164% Morgan Stanley Enhanced Allocation Index. And then what they could do is year two, when during the reset, if this wasn't a guaranteed par rate product, I picked the wrong product, sorry, because the par rates are guaranteed on it. If we picked a non-guaranteed par rate product, every year you could reduce the par rate, say, by 20%, see what then it's going to do for a return for your client, and get a good non-biased opinion on what returns can look like in a decreasing renewal rate market. So we can look at that. And I think that's a tool that we'll continue to use. And it's not ridiculously expensive either, like some of the other ones that are out there. So if you have any thoughts on different softwares, I know there's some great ones out there on the life insurance side as well. I know that a lot of reps will use some really good stuff on the life insurance side. But for the most part, we've never had great success with any of those third-party softwares. And I got to warn you too, just real quick, disclosure on Annuity Rate Watch. We've been burnt a couple of times because they've been wrong. Most recent one is we had a California sale happen, and it showed that it had an income doubler for a nursing home, and it didn't. I think the wholesaler maybe should have known better that most of those are not, but the wholesaler did a good job and called the carrier to verify that it was approved in California, and the carrier said it was, and it wasn't. Client bought it 3 years later, goes to the nursing home, wants to double their income. We had to tell them no. So we had to deal with that, and it wasn't a fun experience. So long story short, use Annuity Rate Watch, just don't trust it 100%. Go get a carrier specific quote every time and trust the carrier specific quote. Because if in that scenario we would have done that, it would have said on the carrier specific quote that it wouldn't have been available in California. And we actually run into that more on SPIAs probably than anything else, because CanX, the income start date, whereas the carrier specific software, you have to plug it in. And a lot of times that'll change the number. So we have a disclosure on every SPIA, not everyone. Most of my marketers will send out a little note on every SPIA quote to call when you get closer to making this sale happen, because rates change very regularly with SPIAs without notice. And also the time frame of how long, 2 weeks of the carrier having the money before income starts is a different income than 6 weeks, as an example. So with SPIAs, you can get yourself in trouble on some of those, so be careful when you're running CanX, but it's a great tool for us to just research the industry to see who's got the best deal.
I think you bring up a good point though, too, Joe, that it's important for us to remember, to be cognizant of there's tools that we use that are very friendly for us as wholesalers, like Annuity Rate Watch. I mean, can you imagine wholesaling without that? But then there's the client-centric stuff. So from the advisor standpoint or the agent standpoint, when you're talking to, as a wholesaler, when you're on their side of the table and you're focused more on the consumer, the client-centric, forward-facing, any kind of software or presentation stuff, it's a totally different thing, right? Versus what is useful for us as a wholesaler. So
I think the best sales tool for an advisor is a yellow pad, frankly, but that's my opinion, of course.
Yeah. Hey, hard to disagree with that.
All right, guys, anything else quick? See ya. Thanks for your time today.
Thanks, Joe.
Bye-bye.